Well, we often talk about looking for value in the stock market, but looking beyond the stock market, there's another value story to tell you about. According to data compiled by Bloomberg, credit is trading at the biggest value gap with equities in more than 2 decades. For more on what that means for income-seeking investors, let's bring in Ed Clissold, Chief U.S. Strategist at Ned Davis Research Group. Ed, it's great to see you. Normally, we keep our conversation centered around the stock market, but what are you seeing in the credit market right now?
Well, we've re-entered a regime that we haven't been in since before the financial crisis, where bond yields have gotten to a high enough level that for income-seeking investors, they really offer an alternative. Whereas last decade, we called it TINA. There is no alternative to equities. Now we're in an era of terror. There are reasonable alternatives to equities, particularly from the bond market. So by several measures, if you look at say the earnings yield for the S&P, so the inverse to PE ratio versus bond yields, bonds look fine. And then also, if you look at the percentage of stocks that are providing dividend yields greater than the 10-year Treasury yield, that's at its lowest level since 2007. So, if you really need that income on a consistent basis, it makes sense to look beyond stocks.
And why do you think that when you've got such an obvious example of credit or fixed income opportunity, that you've got the stock market at an all-time high?
Yeah, so to be clear, this doesn't mean we don't like stocks. So for a balanced portfolio, we actually are overweight stocks. But so there's a few reasons for that. One is, look, the economy is doing fine. Earnings growth is fine. Quarter-on-quarter acceleration in S&P 500 earnings and a high beat rate, percentage of companies beating expectations. We also, if you look at the relative valuation picture, what we've done is we've re-entered the normal range from what it was before the financial crisis. So if you just say, look at the last 15 years ago, wow, stocks are expensive. But if you look at it, say, the last 40, 50 years, which may be a better time frame, what it means is it's really more about balance. And there's one other thing to consider here, and that is because of tax rules and also the flexibility, buybacks have become a lot more attractive. And so actually buybacks have exceeded dividends for the S&P 500 for all but 6 quarters in the past decade plus. So you need to look at buybacks and dividends together to get the idea of what companies are doing to return capital to shareholders.
Ed, if there's a case for bonds and a case for stocks, does the case for a so-called 60-40 split come back on the table? People have been throwing in the towel on that.
Yeah, I think it does need to be considered, and I'd throw in cash as well. In a world where, at least in the U.S., you're getting 5.5%, 6% on cash. It makes sense to have something in a risk-free portfolio, risk-free assets in your portfolio. So no, 60-40 is not dead. In fact, I'd make the argument that over the next 10 years, it's going to become more and more important to have a range of assets in your portfolio.
Okay, and then on the technicals, because you cover a range of metrics in the market, what are you seeing for the outlook from here? A lot of people very curious about whether or not this bull market can continue to run. We had a conversation this week that said actually the gains we've seen in this stock market bull run are or at least the length of the bull market is nothing close to what we've seen historically, so it could continue to run. But like when you look at the trends technically, what are you seeing right now?
Yeah, well, I'd agree with that. That in terms of duration of a bull market, we're not even close to where they usually end. But what we saw in April was a quick, decent pullback, and the market got oversold. Percentage of stocks above their 10-day moving average, so it's very short term, got to its most oversold level since March of last year, right after Silicon Valley Bank foreclosure. So we got oversold, but the long-term technicals didn't break down. And from a technical perspective, that's what you'd like to see. Percentage of stocks above their 200-day moving averages, so longer-term time frame, never got below 63%. And now we're back up to almost 75%. So 3 out of 4 stocks in the U.S. are above their long-term moving averages. That's a pretty bullish setup that suggests the bull market has a while to go.
And then getting to the tech sector specifically, just because it's the only thing people seem to be talking about today with NVIDIA, a company that also unveiled a stock split plan and an increase to its dividend. If the technology companies are increasingly leaning into shareholder-friendly moves, coupled with the growth that they're known for, what message does that send?
Yeah, that's a reason why we like the sector with throwing communication services as well over the long run. I mean, it's really remarkable they can put these massive investments in AI that really very few other companies could handle because it takes so much cash with one hand, and then with the other hand, they can be returning capital to shareholders. So I think it just underscores these are great businesses. This is not .com late in the 90s type of situations with companies that are burning through cash. And so it's a reason to like them over the long run. It doesn't mean they're not going to have pullbacks along the way, but these are really solid businesses.